Hello, and welcome to Vision Advisor. My name is Erwin, and today I want to explain to you what the stock market is, how it works, and how you can participate in it. Did you always want to own a piece of your favorite company and have a say in their decision-making? Then the stock market is the right place for you to invest your money in. Not only that, but it is also a great way to multiply your spare cash in the long term. Warren Buffett once said, "Never invest in a business you cannot understand." So you need to know how this whole system works to use it for your benefits. Whenever people talk about investing money, the first thing that comes to their mind is the stock market. Those who invest are ever mentioning stocks, buying shares, or getting dividends. However, what are the actual meanings of these terms, and how can you benefit from them? While they might sound a bit intimidating or hard to grasp, they can also be essential knowledge if you want to introduce yourself to the world of trading. So, as we were saying, most aspiring investors will hear stocks as their go-to for an introduction to the world of passive income. But what is a stock? Let's begin with a straightforward definition of the word. A stock, also known as equity or share, represents ownership interests of a company. If you've watched Shark Tank or a similar show, most of the participants pitch their existing or soon-to-be business ideas and offer the sharks a percentage of equity of their company. With that percentage, they become an owner of that company, at least partly. How great does that sound? But wait, why would a company sell its ownership to a stranger? What do they gain from that? Let's begin by saying that all corporations sell stocks, and shares are kind of like a slice of pizza, in the way that they are split and shared, with the investors being the ones who end up eating it. Most new businesses will begin with only one or a few owners, which are, of course, the creators of the company, and probably the ones that created the idea in the first place. However, not every company can rely on a hefty starting capital before seeing a return on investment from the beginning. Or even if they do, they might need more cash than they thought of in the first place. Then the corporation goes public, meaning that it sells some of its shares to the public via what is called a stock market. When a buyer obtains stocks, they are entitled to a vote on corporate matters and decisions, as they just paid the company owners to gain the power to decide where things will go next with the company. That sounds pretty neat. However, there are a few downsides of buying stocks. One of the foremost being that holders are the last in line when it comes to getting their money back. If the company goes bankrupt, it has to sell off all its assets. The cash from the asset sale first goes to pay off lenders, employees, and lawyers. So, make sure you invest in a company that is not likely to go bankrupt during the time you are investing in that company. Another reason why a company might prefer going public into the stock market is to avoid having to borrow money and pay high interest rates. When a company is traded public, raising money becomes more comfortable. If the stock is performing well, lenders are more likely to extend their credit, and secondary offerings are more lucrative. A strong performance in the stock market also allows the company to buy other companies with shares of stock rather than with money. The stock market is where all of this magic happens. It operates like an auction house, which can allow buyers and sellers to negotiate prices and make trades. While most companies can go public and sell their shares on the stock market, there are some minimum requirements for them to get listed. It must be able to meet the stock listing requirements and pay the stock's entry and yearly listing fees. These fees may vary depending on the stock. Still, they are needed to make sure that there are only high-quality securities traded on the stock market. Also, it maintains each stock's reputation with their investors. Of course, investors will only spend their hard-earned cash on a share that they trust wholeheartedly. Whoa! After that explanation, even I understand what stocks are and how the stock market works much better. Did you? Let us know in the comments section below. Also, let us know if you have any further questions, and we will answer them to clear any possible confusion up. Don't forget to leave a like, share it with your friends, and also subscribe to our channel.